What's up, everybody? Today, I think I have a treat for you guys. We're going to do a dive into a fairly high quality company that I think is trading for excellent value today. They have higher margins than many of their peers. We'll go over why that is, why they have an advantage. They have fairly solid growth, and we are being offered a reasonable price. The company, as I'm sure you can guess by looking at the screen, is Fiserv, ticker symbol FI. And I mentioned them a little over a week ago when I was doing my video on some payment processors. We looked at Shift4, we looked at PayPal, we looked at Square. These companies are certainly not the same, but they're all involved in a similar business, moving money around. Some of them are more software-based like PayPal. Some of them are more on the merchant side of things where you might have a point of sale terminal like Shift4. And I mentioned I wanted to do a separate video breaking down Fiserv, which is a company I've been looking more and more at. Just so you know, I don't currently own this stock. This is not advice to buy or sell Fiserv. I'm just giving you my opinion. And as always, if you get value out of the video, subscribe to the channel. If you want to download my template, make spreadsheets like this, consider supporting me on Patreon. Now, let's get into it. Fiserv has two main lines of their business. The first is their merchant side of their business. You might have seen some Clover terminals like this. This is a point of sale terminal that a lot of small or medium-sized businesses might use. It looks very similar to Square or Shift4. They also own Carrot, which is a bit more for larger companies, but really Clover is the majority of their merchant segment here. We see small business. This is Clover. This is roughly, 2/3 of their total revenue for this merchant segment. We'll talk more about that in a moment, but in order to understand why I'm excited there, you have to understand a bit about their other segment, which is financial solutions. This is the legacy side of the company. This is their banking. This is their payment processing side of the business. Do you see that they break this down further? Digital payments, issuing, banking right here. For banking, Fiserv has tons of banking clients. They offer processing systems that handle the deposits, the loan, customers' accounts. Basically, they're like the operating system of a bank. So if you have a checking account, for example, at a local bank and your balance has to update after every transaction, it's likely that that's being managed by Fiserv's core banking platform, either Signature, DNA, Premier. They have a number of banking platforms here. I should mention this revenue is very sticky. It's costly and risky for a bank to switch their banking platform. This subsegment is almost completely recurring revenue. In fact, actually, a lot of Fiserv's business is recurring revenue. Now, the next subsegment we're going to talk about here, issuing. This is about 1/3 of total financial revenue here. Their clients here are banks that issue credit or debit cards. Fiserv is often the backbone of that credit card processing system. They're managing everything from the card creation to billing and fraud detection. So if you have, say, a Chase Visa card and you swipe that, somewhere on the back end, something has to verify your card. They have to check your balance, authorize the transaction, update your accounts. For most banks, and certainly for most small and mid-sized banks, they aren't doing that card management themselves. Fiserv, even though they don't own the credit card, they didn't issue the card, they're often handling much of the technology behind it. Now, finally, digital payments. This is the largest subsegment here. There's lots of ways you can move money around at, say, a bank. Most banks offer some kind of bill pay and online, banking payment to your utility, perhaps. There might be some integration with Zelle to transfer money to someone else's account. And Fiserv, you can think of as managing those pipes. They're providing the technology to move that money around. So going back to our sheet really quick, you see that, this was a slow growing, steady company up until, 2019. What happened here? Revenue, it looks like, just shot through the roof, and growth has been increasing since then. Well, what went on is prior to this point, Fiserv's legacy business was this financial solutions side that we just talked about. Their main clients were banks. They dealt with digital payments. In 2019, they acquired First Data. You also see here their debt jumped up. They financed this transaction not only with debt, but also with equity. We see their shares increased significantly during that time as well. And Fiserv became a much larger company. They acquired this whole merchant wing. Clover, Carrot, this whole merchant segment we just talked about, this became an important part of the business after this acquisition. Now, the merchant revenue is actually higher than the revenue for financial solutions. We see merchant revenue this last quarter, about $2.6 billion, growing about 10% year over year. Financial solutions, just under $2.55 billion, growing 7% year over year. So the merchant segment has been growing faster. Clover in particular, this small business subsegment right here, growing very fast. They're competing with Shift4, Toast, Square, all these companies here. But fiserv, I think, has a structural advantage here. And to understand it, let's just quickly look at their operating margins. Maybe actually it's harder to read these small numbers on YouTube. Let's just look at this graph right here. Operating margins is the blue line, net margin is the yellow line here. We see that as they scaled out, this company was slowly becoming more and more profitable. They reached 30% operating margins in 2018, and then they had this big acquisition with First Data, where they acquired this merchant solutions segment. Now, the margins there were much lower, so the combined margin for the whole business dropped. We see operating margins drop down to, 15-ish%. But as they've been scaling out, margins have been increasing back up. We are now back to roughly 30% operating margins, and that's with this merchant side of the business now being half of revenue. So what's been going on here? What's been going on is that the operating margin of that merchant segment has been increasing very quickly. Operating margins for financial solutions is still higher, and it has been growing as well. But really a big success story is the margins in this merchant segment over the past 5 years just becoming incredibly profitable. Now for merchants, operating margin is down a bit year over year, and they're not showing you the longer term trend here, which really has been incredible. A natural question you might have is, why are margins so high in this segment? Clover looks like it's essentially the same thing as Square, Shift4. I mean, all these things, they look really similar. Why are margins so much higher? Square really just becoming profitable. Shift4 also, high single digit operating margins. I was kind of modeling out margins getting to about 12% for both of these companies. Whichever way you slice it, margins for fiserv, even if we aren't taking into account their financial solutions segment, which yes, is very high margin, even if we're not looking at that, the margins here are better. Why? Well, it really has to do with synergies they have with the legacy side of their company, the financial solutions side. Businesses often talk about synergies, and sometimes it's nonsense, but let me explain what's going on here. So to give you an example, let's say you are making a transaction for $100 from some merchant. You're paying with a credit card, maybe a Visa card, and let's say the merchant is using a Clover point of sale terminal. The Clover device is taking those card details, it's sending them through fiserv's own network. The transaction is being routed to the bank that issued the card. Maybe it's, Chase, for example. The bank is approving the charge. fiserv is them authorizing it with the merchant. This is all happening super fast. This is just in those few seconds when you are paying with your credit card. This is all going on. And that $100 minus some fees is going from that issuing bank through fiserv's system to the merchant's account. But since fiserv also operates their own banking system, that settlement, it's usually just flowing through fiserv's own network with their own bank clients. The settlement is happening entirely within fiserv's ecosystem. So just to break down what's going on with the fees, you might have about a 1.8% is going to the interchange fee. That's going to the bank that issued the card. Then you have a network fee to Visa or MasterCard. That's very small. That's 0.1%. Visa and MasterCard, their business is all about scale. So those fees, we're talking about just under 2%. Those are going to be the same whether the merchant is using fiserv or Square. But now here's the difference. Let's say fiserv charges an additional 0.5%. They get to keep pretty much all of that. Square or Toast or someone else, they're going to have to pay someone else to settle this transaction typically. So if Square or Toast is charging an additional 0.5%, well, that doesn't go all to them. They need to split that with some, third-party bank. If they want to make the same amount of money on this transaction as fiserv, they have to charge a higher fee, maybe, I don't know, 0.8%. Either way, Clover, fiserv's merchant solution here, they are going to have significantly better margins for the same take rate compared to these other companies. I think this is just a structural advantage that fiserv has over its competitors. And this is a business where it's tough to have a competitive advantage because, they don't own the customer. The merchant is interacting with the customer, and, the merchant has choices of Clover, Square, Shift4, all these different options for how they want to process that payment. So now just looking at the company as a whole, margins are going up. Revenue's been increasing high single digits, but earnings per share has been increasing faster. Free cash flow is very strong. They're maintaining their view, $5.5 billion in free cash flow for the year. And they are giving a lot of that back to shareholders. Right now, with the stock down, they are aggressively buying back shares. They're spending more money on share buybacks than they have free cash flow. They clearly think the stock is undervalued. If we look over just the past year, fiserv is down about 35%. They're pretty much all the way at their 52-week low right now. Over the long run, this company has still been a massive winner, but clearly management thinks that the stock is cheap right now. They're projecting 10% organic revenue growth, and the bottom line they're thinking is going to grow faster, 15 to 17%. That's because of this margin expansion right here. So it looks quite cheap. I mean, this is incredible growth for a company that, if you look at this adjusted earnings per share, they're only trading at like 12 times adjusted earnings per share here. Now, we should check what in the world is that adjustment that they're making. The big adjustment here is amortization of acquisition-related intangible assets. It's pretty significant, over 20% adjustment to their EPS. This is quite standard. They're not doing something unusual here. Just to explain what's going on. So when they acquired First Data in 2019, obviously they paid a bunch of money. Now, if you went out and you bought a tangible asset like a factory or something like that, you would depreciate the value of that factory over time. You're taking that as an expense. You're basically saying, hey, this factory, it has a life of maybe 20 years. So if you paid $1 million for it, then, maybe if you're depreciating it in a straight line, then each year you're saying, okay, I'm taking an expense of $50,000 for depreciation, so that by the end, by 20 years, you've depreciated the entire value of that factory. Well, in the same way, a company they acquire might have intangible assets. And amortization is like depreciation, but for intangible assets. And similarly, over, a life that you decide, whatever the finite life is, and there are GAAP accounting rules about this stuff. But essentially, you are realizing an accounting expense here every year for a certain number of years. In the case of fiserv, the non-GAAP metric of, adjusted earnings per share that they're reporting here is, I think, really more representative of what's going on with the business. What is the earnings power of the business? So to me, I see a company that's trading for a little over 12 times earnings, that's growing, 10%-ish on the top line, that I think has a structural advantage over their peers. I think this business is looking good. Now, one thing I want to look at before we get into our forecast for the future is their debt. Because fiserv does have a significant amount of debt here. A lot of this is from that acquisition in 2019. We see debt jumped $16 billion just in that year alone. They have not really been paying this debt down. The debt has just been there. In fact, actually, it's been increasing a bit over the past year. This isn't something I love to see, but if you jump over to their 10K here and you search for maturities, if you ever want to find debt in a 10K, typically searching for maturities will get the job done. Now, here we see all their debt. And what do we see? The interest rate on this debt is so low. I mean, 3%. This note is a 1% note, 1.6%. The vast majority of this is fixed rate debt. The weighted average cost of this debt is, I think, a little under 4% here, just about 4%. That's an extremely low interest rate. And even this new debt, this here 2027 note, 5%, 2031 note, 5%. So their new debt is, 5 to 5.5%. It's so cheap. I mean, they're not paying this off for the same reason why I'm not going to pay off my mortgage. If my mortgage rate is 3%, I have no reason to want to pay off that loan early. So their debt is on the higher side of what I would like to see, about 4.5 times operating income, but the interest rate is so low. The payments are manageable out of their free cash flow. Again, this is a very profitable company. So it clearly has been a conscious decision of management that they're okay with a bit of leverage here in the form of their debt. And I think it's acceptable. Now, finally, getting to our forecast for the future. What can we expect for a return on our investment if we invest in fiserv today? My base case here, I think, is quite conservative. Revenue growth of only 7% a year for 5 years. I think that's slightly on the lower side. Operating margin, 30%. I'm essentially saying their margins will not expand more from where they are now. Yes, they've had this expansion over the past several years, but right now, 30%, bam, that's just where it is. No more margin expansion. Keeping their free cash flow margin roughly in line with where it's been, and I'm not giving them any multiple expansion. This company is trading for a 15 times multiple of enterprise value to operating income right now. Remember, enterprise value, that it is taking into account all the debt that this company has. This is obviously cheap to where the company has been over the past decade, but I'm not giving them any credit for multiple expansion. And even still, you are looking at a 16% annualized return over 5 years for fiserv stock. That is more than a double over 5 years for what I think are pretty reasonable assumptions. As far as a bear scenario, I think I was just so pessimistic here. 3% revenue growth. It's really hard for me to imagine that. Operating margins coming back to 26%. I brought their multiple down to a 12. I think you definitely could make the case that I'm being way too pessimistic here, but I just want to show these are the assumptions you would have to put in to be flat on your money for fiserv over the next 5 years. I think the risk on this stock is pretty low. And as far as what the upside could be, if they continue growing revenue 10%, If operating margins continue to have some expansion, I'm going to give them a bit of credit for margin expansion here. Free cash flow margin, the money that could be coming back to us shareholders, I'm going to keep that where it is right now, 22%. And as far as a multiple for what we could give this company, I think a 20 times multiple is fair. And in this scenario, you are looking at a 30% annualized return on fiserv stock. This is more than a triple, close to a quadruple on your money over 5 years. So I think the risk reward here looks really good. I like what I'm seeing. Again, I don't currently own a position here, but I am considering entering one. I like the company. I like the business. You can see what my base case implies for annualized return at different prices of the stock. So, if we drop down to $100, $100 to $10, I think I'm going to be really interested. Again, this is just my opinion. I'm not giving advice to anyone. Just tell you what I'm doing with my money. So if you got value out of this video, subscribe to the channel. If you agree or disagree with anything I said, let me know down in the comments below. If you want to make sheets like this, consider supporting me on Patreon. And as always, I hope to see you all in another video.